Karen, thanks so much for joining us today. It's great to have you.
Thanks for having me.
Want to kick off the conversation with your outlook for the economy. The economy keeps surprising to the upside. Third quarter GDP clocked in at 2.8%, boosted by strong consumer spending, up 3.7%. We're seeing household incomes and savings revised upwards. Can this strength continue into next year?
You know, I think it's a remarkably resilient economy because it's a very different economy than what you usually see this far into an expansion. So usually when you get this far into an expansion, a lot of what's going on is that a lot of borrowing has started getting going, right? And so rather than people just spending out of their incomes, they're spending money they borrowed, and that's vulnerable. It means that Fed raises rates, cuts it off. What happened this time around is that the Fed did cut that off. The Fed did raise rates, it did cut off all the borrowing that occurred, and yet because of where we were with all that extra stimulus coming out of COVID, people still had checks to spend. That income cycle where people can spend their incomes was actually just getting going as the Fed had cut off the borrowing. And so you have this economy where households are spending, they're spending well, but they're spending mostly out of incomes. And on the business side, a lot of the spending is also very resilient because it's not that reliant on seeing demand. Companies are telling you, I am spending for existential reasons. I have to invest in AI. The big risk is to underinvest, not to overinvest. In other words, even if my customers don't have demand now, I'm still going to spend that money. So that is a very resilient set of sources of spending. Then you add to that the Fed being able to ease into an environment of falling inflation and a Trump presidency probably being able to deliver a little more fiscal stimulus. That means we could probably get some borrowing restarted in this environment. I think that's quite a resilient expansion this many years in. Very rare, very unusual.
But does it continue into 2025?
I think so. I think it's got real room to run because I think the Fed has just delivered a little bit of easing. They're likely going to deliver a little bit more. That is at least a little bit of fuel. You're likely to get a little more fiscal stimulus. That's a little more fuel. And then a lot of the spending that's happening today, it doesn't have as many natural ways of kind of running out of steam. So I think we got an expansion that has a ways to run here.
You mentioned potential fiscal upside from the incoming administration. How do you expect President-elect Donald Trump's policies, from mass deportations to tariffs, tax cuts, deregulation, to influence your outlook for the economy?
Well, I think what's been interesting is that this time around, relative to 2016, the markets have had a pretty consistent view. As things were getting priced along the way, as his odds rose, that's the same thing you saw after he got elected. And markets are basically telling you more or less, Donald Trump means somewhat good for growth, somewhat inflationary. And so you're getting higher yields, you're getting a slightly stronger stock market, you're getting a stronger dollar, and it makes sense. You know that Trump and his team are believers in tariffs, that they really believe that's the right way to go. That has to be to some degree inflationary. You know they're believers in stopping the flow of immigration. That has to be to some degree inflationary. And the plans they put forward of what they want to do with the deficit are, to slightly increase the deficit, certainly not to reduce it, and to do things that are going to be stimulative. And so they want to create a stimulative environment. I think they hope they have is that you'll get enough productivity happening on the other side of that it won't be too inflationary. And that's very hard to predict. We're currently on a great run of productivity. You read the Europeans talking about how bad their productivity story's been relative to the United States. There's a lot of good things that have been happening here in terms of productivity, and potentially we have a big leg ahead of us as AI actually hits and actually impacts productivity. But it's risky because that is a very inflationary set of policies that is going to be generated. And so I think that the big question with the Trump set of policies is what will they actually be able to implement? How inflationary will it end up really being?
Two follow-ups. One, it sounds like you do expect robust growth under the incoming administration. Is that right?
Yes.
Okay. Secondly, let's drill into the tariffs, because last time Trump was in power, he slapped targeted tariffs on China. This time, he's pledging for across-the-board tariffs, 10% on all U.S. imports, 60% on Chinese imports. I recognize that there could be some negotiations. On the flip side, there could be retaliation. We don't know about the timing and actual extent of that. But if we were to see the scenario that he has put forth implemented, what impact do you expect on inflation and growth?
Well, look, as you've said, these are definitely bigger tariffs than we got in 2016. So the impact's going to be larger. I mean, it's hard to put real numbers because the biggest thing you don't know is what the second and third order consequences are going to be. In other words, it's not just that we put tariffs on others, they can also put tariffs back on us, and you don't know what that kind of spiral is like. What I will say is the US is less vulnerable to tariffs than other countries, so it does give some sense of sort of who has the incentives to escalate and why the policies are coming from here. But the kind of tariffs Trump is talking about, I think are, could easily be 50 basis points of inflation, which in the environment we were in 2016 was not a big deal. In the environment we're in today, it's a bigger deal, and it's more likely to kind of hit us into limits of what's possible. That said, I think that the Fed is very likely to look at that as somewhat of a one-time hit. And so you could get a situation where a lot of tariffs go through, that raises price levels, but that's seen as a one-time rise to price levels. Not that appropriate for the Fed to be tightening into that if it's a one-time and done. And if it ends up hurting growth, actually being a reason to keep easing into that and make sure it doesn't hurt growth too much. So all of that adds up to we probably still have room to run on growth, even under a scenario of tariffs, with a lot of the unknowns happening from what happens with our allies, who retaliates, what's the second and third order here.
So looking at inflation in the near term, it's within shouting distance of the Fed's 2% target. On a core basis, more persistent. You've talked about the potential upside risks to inflation given the president-elect's proposed policies. Where do you see inflation settling out as we go through 2025?
Well, I think there is a really fundamental paradigm shift that's occurred, right? Where there was a long period where there was almost a gravitational pull of inflation to probably like 1-ish%. And that meant that there was just a lot of room for policy to run. And we know why that happened. We know the environment of globalization and the fact that when you looked at spending that was happening by corporates, it was very often spending that while it was spending, it was deflationary spending. They knew by spending, they would take cost out of the equation and make their products cheaper as a result. That has fundamentally changed. A lot of spending now is inflationary. You know that if your job is to say, I'm worried about over-reliance on China, let me go build another supply chain, you're not taking cost out, you're adding cost. You know you're doing that, right? Even spending on things like AI, while down the road may be deflationary, in the near term, it's definitely not deflationary. In the near term, you're pressuring up all the prices of all the inputs and energy and so on that you need to kind of create for AI. So I think the gravitational pull has moved to where the normal level of inflation is probably more like 2.5-ish or something, which it's not horrible. I think the Fed could be totally comfortable with that, but it means it's much easier to get over your skis and say, wait a minute, I'm worried about inflation than it used to be. There's just less room, and we're just used to an environment for, a few decades here, where every time there was a problem in growth, inflation was just not a factor. You could ease into that, it wasn't a problem.
On the Fed, do you expect another rate cut in December? And given what you just said, would you expect fewer rate cuts in 2025? Right now, they've penciled in 4 more rate cuts for next year. Of course, they have the ability to retool that forecast at their December meeting.
Look, I think this is the case where the market has actually done the right move, which is the market today is pricing in radically less cuts than it was just 2 or 3 weeks ago. And so the market saw that, pre-Trump victory, significantly more likely that the Fed would really be able to ease all the way down to like 3. And now it's thinking the Fed's going to ease more to like 4. So that's not a lot of rate cuts. That's not that many rate cuts that's left. So I think the market pricing at this point is somewhat reasonable. Now, if you just step back for a second and you say, look, the hardest thing in setting monetary policy is nobody really knows what the normal level of monetary policy is, right? It's a guess. It's a guess we all make, and certainly what we know is it's not what it used to be. I just talked about, kind of the gravitational pull of inflation. You could also talk about the fact that we needed negative real interest rates for a long time to deal with all of our debt burdens, and we don't anymore. And so what we know is there used to be some necessary interest rate, neutral interest rate that was very low, and now it's gone up. We don't really know exactly what it is. So if you look at what the Fed's guess is, it's guessing, a little less than 1, something like that, plus 2%, gets us to like maybe 3 is like a normal interest rate. They know that they don't know. And the big thing the market is telling you from saying the rates aren't even going to get all the way to 3 is, wait a minute, this isn't a time for neutral rates. Yes, the Fed is normalizing interest rates. We were especially tight, and then inflation came down, and so that kind of raised interest rates more than we needed. But maybe even at the end of 2025 and in 2026, we'll need higher than normal interest rates, more like 4%. And I think that's about the right call.
So what does all of this mean for your outlook for the stock market? It has certainly been juiced on Trump being reelected, on the hope for greater growth, a viewpoint that you share. Major averages trading at near record all-time highs. Can this continue through this year and for 2025?
Look, I'll say the two sides. On one hand, if you just ask me, not knowing anything about what investors already hold, I think the stock market is a good thing to hold right now, and I'm pretty positive on it. And the analogy I would make is think about 1998, right? In 1998, you could say, yes, we're in an expansion, but aren't valuations already high? And the answer is no, they got a lot higher than that, meaningfully higher than that. You ain't seen nothing yet what actual bubble valuations mean. In 1998, like today, you had a Fed that was easing into kind of an unrelated set of problems, and you had a sense that it was kind of a mid-cycle easing that gave a lot of fuel for the stock market to keep going up. So I think there's a lot of reason to believe that the stock market has room to run, and that the most negative aspect is valuations have gotten somewhat stretched, but not that stretched. In the most stretched corners of the market, when you look at things like AI, valuations have gone up somewhat, but also to a large extent have kept up with actual earnings increases, with what's actually occurred in AI, which has been a big deal, right? On the other hand, what you can't ignore is that people's exposure to the stock market today is radically different than normal. People are very, very exposed to the stock market. So almost any portfolio I look at, whether it's an individual investor or an institutional investor, what you see is that almost any source of diversification people used to have has really eroded because you've had such a run. So you just go through such a long time where just buying the S&P 500 is the best thing you could do, that you say, what do I need all this other stuff for? If I just bought the S&P, that'd be the best thing to hold. And so that leaves you in a spot where you can both believe the stock market could do pretty well and say, well, most people are actually over-concentrated there and would actually do well to have some sense of diversification, because it's not like there are never risks. There are always risks you can't foresee. You could have risk to growth, you could have risk to inflation, you could end up blowing up a bubble that, obviously the bubble that burst in 1999 was very, very bad for people's portfolios for a long time. You don't want to be undiversified, even with a positive outlook for the stock markets.
So are you recommending that clients buy now into the next year? How are you recommending clients position themselves?
I see very few people that need to buy more because people are so positioned in the stock market. So I both think the stock market is attractive and that on the margin, the next trade people need to make is usually to something else for more diversification. I'll give you an example, right? It used to be that kind of a median portfolio was kind of like a 60-40. I hold stocks, I hold bonds, I hold about 40% bonds. Very few people hold that. That median 60-40 has moved to maybe even 80-20. And I think there was good reason for that, for a while, to kind of say, wait a minute, what am I really getting out of my bonds, right? Yields are so low. What's the point? If there's a big shock, the way bonds usually can help me is that the Fed can ease into that. Can they really ease when rates are already zero? Why am I holding this? Clearly not the case today. Today, you could say, if there is a big shock, bonds could actually help you. And then the flip side of that, bonds can really help you only if the shock is more of a growth shock. If the problem is inflationary, bonds aren't going to help you. People have very little inflation protection. And so I think the next marginal move that most helps our clients is either moving to something that'll help them to growth shock, like bonds, moving to something that'll help them to inflation shock, like gold, or a little out of the box, thinking, where can I be in the world that is diversifying? How can I geographically diversify? So if there's a problem in the US, I'm just less likely to hit it in another geography.
If people are already so exposed to stocks right now, does that put a cap on the amount of upside that we could see over the next year? Because if people have already deployed all of their cash into the market, what are the odds that we see a repeat of what we've seen this year?
I think that valuations and how much money is deployed does sort of cap stocks to a degree, unless you get such a blow up in expectations, like a real bubble, kind of expanding. And I think one of the easy ways to see that is you look at what is the earnings growth that would be necessary for stocks to perform much better than bonds. And the answer is, it's pretty high earnings growth. And so I think companies could do really well, deliver great earnings, and still holding stocks will just kind of be mediocre because it's already in the price, it's already expected. And this is very classic. When you have a lot of period of good performance, usually it starts out, like we did after great financial crisis, with very low expectations. It's easy to beat them. But once you beat expectations for a long time, it starts pricing in those expectations are going to come again, right? And so at this point, the US could do great. We could have a strong economy and continuing expansion. Companies could deliver, and still stocks could be just kind of so-so because the price is already, kind of expecting that. And you could still do better actually holding stocks potentially of countries where they could do a lot worse economically than us, but just expectations are low.
Do you see more volatility next year?
Look, I think that when you get a new set of policy regimes, it's always a possibility of volatility because you just don't know exactly how the policies are going to hit. And so I think that Trump's presidency, in many ways, the type of policies he's doing were already in the air and would have happened with him or without him, right? More protectionism, more of, I'd say, a shift from a sense that it doesn't matter what our economy produces. As long as we have a strong economy, who cares what it produces? Saying, no, it really matters what it produces. We care about the composition. We want manufacturing here. We want to have certain exposures where we control our access to things like critical minerals. Between that and protectionism, those things would have been kind of in the air under a Harris administration as well. But no doubt that Trump and his administration are going to accelerate that, are going to push harder, are going to try to go more extreme, are going to try to really move the agenda forward. And so you just don't know what kind of volatility that'll generate. And I think with any shift, we're in such a broad shift of just where we are geopolitically. Thinking that volatility is possible has to be in your map. I'll use oil as an example, right? Which is, on one hand, you say, look, there's a lot of oil in the world. It's very rare to have as much spare capacity as there is today. The Saudis are kind of sitting there saying, if you just give us a chance, we'd love to pump more oil into the market. We just don't want to get prices too low. At the same time, you have a Trump administration that doesn't love the idea of Iran having as much oil as it does in the markets and could easily tighten sanctions on it. You have an Iranian regime that you can't call predictable. So is it a high probability that you'll get a huge geopolitically driven move in oil? I don't think it's a high probability, but it's certainly possible. And it's certainly the kind of thing that you'd want to have, perspective on whether that could happen to you.
Lightning round.
Okay,
so the yield on the 10-year Treasury is up, better than 70 basis points since the Fed first started cutting. The Fed's already cut 75 basis points. What do you think that means for markets? What is your outlook for the yield on the 10-year? Is there a certain level on Treasuries that causes stocks to fall?
I think it's just about right now. I think that upward yield made sense. The Fed will have a hard time easing as much as was priced in a few weeks ago because it's such a strong economy, because inflation's it's not as low as they want it to be. I think that repricing was about right. I think it's pricing in the fiscal stimulus that's coming, the fact that more is going to be issued, that it's about right. And the reason it hasn't hit the stock market is very simply because if the yield is rising partly because growth is going to be stronger, that effect's going to be stronger on the stock market.
But is there a certain level that causes stocks to fall? If we hit 5%?
I think it's much more the reasoning, right? Like if you get a repricing to 5% because inflation is sticky and the Fed has to actually tighten conditions to stop the inflation, that's gonna be very bad for stocks. If it gets to 5 because growth is just booming, not necessarily.
Gold, where do you see gold going? Do we hit 3,000 next year?
Look, I like gold a lot. I think that it's fallen in the last couple of days for reasons that are partly just positioning reversals or partly what's happening to yields to the dollar. There's just a lot of people around the world that have realized that the dollar is not necessarily a safe place for them to be from a geopolitical perspective. And it's very hard for them to move the price of big markets like the dollar, but it's very easy to move the price of gold. And so that's a lot of buyers. And while yields were rising, there was a natural seller, which is people sat in the United States and said, why would I hold like a shiny rock rather than something that pays me a yield? But yields aren't rising anymore. I don't think I have a reason to rise a lot from here. There isn't a natural seller the same way. A lot of natural buyers. I like gold.
Crypto, Bitcoin's all-time highs. Coinbase's stock up some 70% over the last 5 sessions. Where do you see the price of Bitcoin going? Do you have any recommendations? What are you telling your clients about?
It's honestly not something we have invested in, and so I don't feel qualified to give a recommendation.
All right, last question. What about oil?
As I said before, I think kind of the median case is that oil probably kind of stays range bound, is weak. There's just a lot out there, but you just have these potential upside risks that have to do with enforcing the sanctions or what might happen geopolitically. And so I like oil and general commodity exposure alongside gold as something to have in your portfolio if there is stickier than expected inflation. It's a nice inflation protection to have. If you look at the last, if you look at every time the stock market's fallen, call it more than 15%, so it's actually impactful to people. You could more or less split those into 2 camps. Ones where bonds really helped you because the problem was growth and the Fed could ease, and ones where commodities and gold really helped you because the problem was inflation, the Fed couldn't ease into that, and you really wanted inflation protection assets. So I like having those things in my portfolio.
Karen, we'll have to leave the conversation there, but thank you so much for your insights. So appreciate it.
Thank you.